Ronald says, I have two option services that I get options trades from the same. They always say to be sure to use stops, but they never say what the percent stop should be at, like 25%. Okay. I don't think I'm going to be able to pull up the slide here without digging, and that would be a waste of everyone's time, Ronald. But in any case, related to your question, you said you have two option services that are selecting trades for you, and they say, I always use a stop, but they don't say which one. What is a good stop to use? 25% or so. Last time I did a webinar on I apologize, long calls and long puts. Okay, so you continue typing. Sorry, said it to you, was not done typing. Anyway, where do you say the stop should be at percent? Is it 25, 35, or 45%? Okay. This is a tricky one because it is based on strategy. I can assume right now that you're talking about call buying and put buying, which is why I originally said, I'm sorry, you're getting trades that are call buying and put buying because you were asking about a stop. Now, the last time I ran one of these webinars, we took a poll and we said, what do you feel is a good stop range to use for buying calls and buying puts? It's probably in the archives there in that free webinar section, Ronald, and I think it's in the section of option strategies, of course, on buying options. But I took this poll, and we asked the question, where would you set your stop for a long call or long put trade? And, which we put it at 10 or 15%. Would you put it at, let's call it 15 to 25? The numbers weren't set up exactly as I should have, but it was close. Would you set it up for 25 to 33, I think it was, or would it be between 33%, that's going to cut off, to 50? Okay, I think 90% of the answers were here. And the bulk of it, the majority, was 33% to 50%. So when you're buying a call, if you start to lose 40, 45, 50% on the call, that's your trigger. There's a few people here, it's like, well, 10% was here, and maybe, no, single digits here. 8% was here, and I think 27% was here, something like that. Oh, no, 17. I'm sorry, yes, it was total 25, 75, 80% of the answers were in these two blocks, and the majority was in 33 to 50%. Now, that sounds like a lot on a long call, right? I buy a call option. I pay $10 per contract for the call. I don't want to see it go down 50% and go down to a 5-point loss and close it. Because one thing that we know, of course, is gambler's ruin. What does gambler's ruin tell you? Well, if you take a 5% loss on a position, you only need a 5.3% gain to get back to break even. If you take a 10% loss, you need 11.1%. You take a 25% loss, you need a 33% gain on what you have left to get back to break even. If you take a 33% loss, you need a 50%. You take a 50% loss on a trade, you need a 100% gain on what you have remaining to get back to break even. Okay? So that's gambler's ruin in this case. So why would I ever set a stop? By the way, this is personally where I am, Ronald, when if I do a long call or a long put, my stop is set about 50%. Why? Because if I bought this option at 10, and this is a trick of the brokers, but it's also the trick of the market. Let's say I got filled a little bit above midpoint. I wanted midpoint at 980. They didn't give it to me. I moved it up to 10. Let's say the ask price is at 1050 and the bid is at 850. Okay, so it's 2 points between 950 midpoint. He didn't let me get filled at 950. I got filled at 10. What is the worst case scenario I get back if I sell to close this call? It's the bid, right? The market my brokerage, market makers can't guarantee I'm going to get the ask or midpoint. The worst case scenario is this. What does that tell you? Already, if I got filled at 10 and the options bid is at 850 and I put in a 10% stop order, I'm closed immediately because they're basing it likely on the worst case scenario of getting filled, which is starting off 15% lower than what I paid. So that's why no one was answering that they, very few percentage were saying they were trying to put their stop at 10 to 15%. The one person attending the webinar did when we started talking about this, he said, oh, that's why I've been losing. And that's the key. If you set a stop on long calls, on your long calls because you want to control the risk better and you put a stop or a trailing stop at 10 or 15%, you're probably close to that already with bid-ask slippage, which means you're probably getting closed out of positions 75 to 80% of the time right after you've opened them. That's not a winning record. Can't have that. Yes, you controlled your loss at 10 or 15%, but now you've only got 25 trades that are being allowed to grow to get close to the return you were hoping to make if the market goes the right direction. That's a no-no. That's too low. 15 to 20%, still a little bit skewed in this direction where you're closing out too often. 20% would be great, but in the example I just gave you with a bid of 850, you're starting off. Okay, so let's say I bought this position Tuesday, 2 weeks ago, and Wednesday something comes out and China says, no, you know what, we're going to retaliate, and the market pulls back. Been in the position 2 days, I'm out. Right, so I took my 15 or 20% loss. Now the trick with that is also risky. The bid was 850, I opened it here. I'm close to a 15% loss at the open when I got in the position, but I put a 20% stop. There's my stop. Okay, the bid is already close to 15%, not much wiggle room. The market's open and every stock falls 3%. This drops down to $7. My call, notice how I'm not even talking about strike or expiration date. I'm just talking about the moneyness here. That's all we need to see with this discussion. I don't even need to talk about a strike or which strike is the best. We're just strictly talking about the stops and the risks. The stock falls down to $7. Well, whatever strike I purchased for 10, it's going to get hit by this movement. Either I lost, $3 roughly of intrinsic value, or I gave up, if it was out of the money and it was 6 months out, I gave up some to the, of course, extrinsic value. Either way, now my position's down 30%. What can't my broker do? My broker gets a trigger. It says he put a stop at 20 or 25%. Let's close it for a 20, 25% loss. No. I get filled at the 30 to 35% loss that the market's offering. All this was a market order to tell them to get out of my position if this is ever hit. If it drops 40% for some news that came out pre or after market, my option is, the stock falls 40%, my option's probably at an 80% loss, and that's what I get filled on. I can't get the 20% stop I hit. That's when it hurts you the most, okay? So 33% range, 33 to 35, that's a common range I talk to about long call investors that they use. I go more. I go higher. Not that I want to take a 40 or 45% loss, but in this headline-driven market, if I bought an in-the-money call, let's say it was 5 or 6 points in the money, and it was a few months out in time, and we have a day, an 800 down day, a 600 down day, because someone geopolitically, geoeconomically opened their mouth, threw tariff around this way, that way, something else comes out, the stocks fall 500 or 600 points, you're probably looking at close to a 40, 50, 60% loss in your call. We'd both get closed out, okay? But sometimes it might only be a 35% drawdown, a 30% drawdown with the market correction that day. Well, I don't want to close out. Maybe I want to accept that because I think things are going to recover. And they sort of did, right? It took some time, but they sort of recovered to levels where they were at after the last $800, $600 drop, right? We still have more to gain, of course, but that's the key. So long call trading, long put trading, if you're going to use the value of the option to set your stop on the position, I'd probably set it somewhere, as well as most of the people who attended the webinar answered, 35 to 50%. I know that's a broad range, but I can't answer the question directly. You've got to kind of figure that out, what you're more comfortable with. There's nothing wrong with trying to be conservative and putting a stop at 30%, 33%. I'm going to say there's nothing wrong with being conservative and putting a stop on these long options at 25%, but be aware of the kind of headline-driven market that we're in. And any given day when the unexpected happens, you could easily hit that 25, 30% loss on your long call or your long put in an instant, where as if you were able to stay in the position with not using the stop, you might have actually turned a profit on the position 10, 12, 15 days later. That's why it's a tough game to play. Regarding other strategies, Ronald, what I'm going to say is that in other strategies, I don't actually use the price as a stop. Meaning the option price. I don't use the option premium as a stop. I set stops based on the stock price. So when the bull put credit spreads, I look for an original 85% probability above. I look for a return of maybe 11, well, my average return is about 15.1%, but I look for return greater than 9%. 85% probability, equates to a delta of around 0.12 or 0.13 for the short put. And I'm usually 3% out of the money or so. And the net credit, let's say, is an average of about 23 cents, okay, for a 2-week out trade and a 2-point risk. That's a 2.5-point risk. Anyway, 23 cents. Some people say, oh, it's best to close when you've got 50% of the realized profit, or if your loss hits 50%, meaning to liquidate, it goes from 23 up to 35. No, that can happen too often with fluctuations in volatility where my position is still out of the money. What I tend to use for the spreads is if the stock reaches within 1 or 1.5% of my pivot, the sold option, that's when I might look to potentially consider a management technique or an adjustment. I'm basing it on the stock price, not basing it on the delta or probability, not basing it on the options price as well. I am kind of basing it on the range out of the money, which is one of the criteria I use to get in. Okay, the different strategy to me would dictate what percentage stop to use. On a covered call, most investors will tell you to follow the IBD rule. And standard IBD rule is that, you use a 7% stop on a stock. Well, a lot of covered call traders would say that yes, and the same thing, even though you generated some premium to lower your cost basis on this call position, you should probably use a stop of about 7%, 7 to 8%, I believe, is the IBD rule. And that's what a lot of cover and call investors set as well. Some will set it at 5%. Okay, so depending on the strategy dictates, are you using the stock as a stop, as a trigger, I should say, in that case, or using the option price. And for long calls and long puts, I will use the option price. Calendar spreads, I might do it as well. Debit spreads, I might consider that also. If the debit that I paid, I'm losing 50% of the debit I paid into a diagonal spread, diagonal is probably closer to 30, 35 for me in that case. So that's what's going to dictate. But for those long calls, what we've talked about in the webinars, what the attendees in those webinars and long calls showed us is that the average investor is probably looking somewhere between 35, 50% as a stop as well. Okay, and then those big losses can hurt you. And so some of the times it's better maybe not to use a stop or a trailing stop on long calls, because if you start getting closed out too much on these positions, and it turns around later that they would have been profitable, then you would have been able to just left it alone and have been successful. Okay.